In the span of one trading week, silver did something that most markets are never supposed to do. 60, then it collapsed to 85, a 28% drop that erased months of price discovery in hours. Not months, not weeks. In roughly 48 hours of real panic, the tape went from euphoria to liquidation. And the strangest part is this. Right as the move looked unstoppable, the market started behaving as if it had hit an invisible floor, a level that price kept snapping back toward after every shove lower. They said this could never happen in a deep, liquid market. They said modern risk controls made 1980-style blowups impossible. Yet when the candles got tall enough, the machinery that runs the metal market revealed its oldest truth. Floors are not just technical lines on a chart. Floors are collateral events. Floors are inventory events. Floors are survival events. And when you see one form, it usually means someone with real balance sheet has decided that this level cannot break without a fight. Here's the part most people miss. By the time the public notices a floor, the institutions have already been working it. Not because they're psychic, but because they're plugged into the pipes that retail never sees. Margin schedules, warehouse categories, lease rates, ETF creation baskets, delivery notices, and the quiet, boring language of clearinghouses. When those pipes start to groan, the price becomes the last thing to update. What I'm about to lay out isn't a conspiracy story, it's a mechanical story. A story about how big money defends certain levels in silver, not out of kindness, but out of necessity. Welcome to Signal and Noise, the channel that decodes market plumbing before it becomes a headline. If you like analysis that stays calm when prices get loud, consider subscribing the way you'd keep the number of a wise elder. Comment where you're watching from right now, too. Let's start with what actually happened, because the sequence matters. 60 earlier in the week, then on Friday, it tanked to 85. That is not a normal retracement. That is a margin event. When a market moves that far, that fast, the most important participants are not the people who have an opinion. They are the people who are levered. Futures traders, option sellers, structured product desks, commodity funds, and anyone whose position size was built for normal volatility, not this. And right as the move was exploding, the exchange did what exchanges always do when volatility threatens the system. On January 31st, 2026, CME raised margin requirements for silver futures. 1% effective at Monday's close. That sounds like a small line in a notice, but it changes the physics of the market. Margin is the price of staying in the game. Raise it, and you force participants to either post more collateral or reduce exposure. Not later. Not when they feel like it. Immediately, because the clock is part of the mechanism. This is where the mystery begins. If margin hikes force selling, why would that create a floor instead of a free fall? Because margin hikes don't only kick out the weak. They also draw a boundary around who remains. After the purge, the market is held by whoever can post collateral without blinking. That's when levels become defended, not by hope, but by capacity. To see the pattern, you have to rewind to other moments when silver looked unstoppable, then suddenly wasn't. And notice what always shows up in the same week. Rule changes, collateral shocks, and a scramble for deliverable metal. In 1980, silver became the stage for one of the most famous commodity dramas in history. Prices surged as concentrated buying collided with a thin physical market. Then the rules changed. Margin requirements rose, trading conditions tightened, the market reversed violently, and what followed was not just a price drop, but a structural reset that punished leverage and rewarded liquidity. The lesson wasn't that silver can't go up. The lesson was that when silver goes up too fast, the system protects itself with collateral. In 2011, the playbook returned in modern form. Silver ran toward the 50 area, then the exchange raised margins multiple times in rapid succession. The price broke, and a generation learned that paper silver can fall faster than physical narratives can update. The same shape appeared, a vertical rise, a sudden tightening of collateral, then a crash that looked irrational until you counted the forced sellers. And after the crash, there were levels where price stopped falling as if it hit concrete. Those levels were where the participant set changed. Now look at January 2026 through that lens. The result is a culling. And after a culling, floors appear because the participant set changes. So who are the players when a silver floor forms? Start with the clearinghouse and the exchange complex because they set the rules of survival. CME, through its risk committees and margin models, responds to volatility by increasing the money required to hold contracts. That is not a moral judgment. It is system maintenance. If prices can gap, the exchange must make sure defaults don't cascade. In doing so, it can unintentionally dictate the timing of liquidation because a margin increase has a deadline, and deadlines force action. Then you have the futures ecosystem. Market makers, proprietary trading firms, hedge funds, commodity trading advisors, and banks that intermediate flow. Some of these players are directional. Others are neutral on paper, but short volatility through option structures. When volatility spikes, short volatility positions can bleed even if the underlying price is moving in their favor. That's why margin hikes matter. They don't just hit the long side. They hit whoever has risk-weighted exposure and needs financing to carry it. Next are the warehouses and the delivery apparatus. Silver futures are not just bets. They are contracts with a delivery mechanism attached. And that mechanism relies on warehouse categories that most people never think about. One category is eligible, another is registered. Eligible can be stored, but registered is the portion earmarked as deliverable against futures. When traders talk about available silver, they often mean registered, because that's what can satisfy delivery inside the exchange rulebook without additional steps. 0.7 million ounces, with a daily change showing nearly 1 million ounces moving out. The exact daily wiggle is less important than the signal. The deliverable pool can shift, and those shifts become meaningful when stress rises. In quiet times, registered levels are trivia. In volatile times, registered levels become a pressure gauge. Then you have ETFs and large pooled vehicles, which are often described as physical. 60 ounces in trust as of February 3rd, 2026. That is an enormous stockpile on paper. It creates an impression that the world is awash in silver. Finally, you have regulators and reporting bodies. The CFTC publishes positioning data that hints at how speculative money is leaning. 2,000 in the prior reading. That kind of shift is subtle, but it matters when you're trying to identify whether the marginal buyer is still adding or starting to retreat. Floors often show up when the marginal buyer steps back, and the market is forced to find a sturdier owner. Now, here's where it gets interesting. But if you look at the system, you see two markets telling opposite stories at the same time. One story is the paper market story. It says silver is liquid, inventories are big, and volatility is just a repricing. In that story, margin hikes are prudent, speculative length is manageable, and any floor is just technical support where traders decide the selling went too far. The other story is the location and conversion story. It says the problem is not whether silver exists, but whether it can be mobilized. Metal can be plentiful in one place and scarce in another. It can be owned by long-term holders who have no incentive to lend it. It can be in forms that require refining, assaying, or transport before it satisfies a specific delivery rule. And in those moments, the market can show a paradox. Big total inventory numbers alongside real tightness for deliverable units. When those stories collide, you get a dislocation. And dislocations are where floors form because the market must reconcile conflicting signals. It can do that in two ways. Either the paper price falls until it discourages demand and forces metal to be offered, or the paper price stabilizes, and the system finds alternate ways to source supply, sometimes by shifting flows between venues, sometimes by changing settlement incentives, sometimes by making it painful to stand for delivery. This is the silver floor theory in one sentence. Certain levels are defended because breaking them would force the system to resolve a physical and collateral mismatch all at once, and that resolution is expensive. Let me make that concrete. Imagine a crowded theater where the exits are sized for normal foot traffic. On a normal night, everyone leaves fine. But if there's a scare, the exits become the bottleneck. The building doesn't run out of people, it runs out of throughput. The problem is flow, not existence. Silver is similar in stress. The market doesn't run out of silver. It runs out of deliverable, financeable silver at speed. Now add leverage. In our theater, imagine half the crowd is carrying heavy boxes they borrowed. If the manager suddenly says, "You can only carry those boxes if you pay a deposit," many drop the boxes immediately because they can't afford the deposit. That's your margin hike. It forces liquidation of leveraged exposure, which can slam the price. But after the drop, the crowd is smaller, and the remaining people are the ones who can pay the deposit. That changes behavior. The market becomes less fragile. And if, at the same time, the bottleneck at the exit is still there, the manager has an incentive to keep the crowd calm. In markets, that calm often shows up as a defended level, where buying appears not because everyone loves the asset, but because certain participants need stability to manage the pipeline. So who would need a floor in silver? Consider the entities that warehouse and finance metal. Large bullion banks and clearing members make markets. They intermediate between futures, spot, and physical flows. They rely on hedging. They rely on predictable collateral. If price free falls through key levels, volatility spikes again, margin requirements rise again, and the cost of maintaining hedges increases. At some point, it becomes cheaper for these players to absorb flow and stabilize the market than to let the system spiral into a self-feeding liquidation. Consider industrial users. Silver is not just an investment metal, it is used. When price swings violently, procurement becomes riskier. Some commercial hedgers may step in at certain levels to lock in costs, not as a bullish statement, but as a budgeting requirement. Their flows are not huge every day, but in the aftermath of a purge, they can matter because they are not trading a narrative. They are managing a supply chain. Consider the ETF ecosystem. Large ETFs can create and redeem shares through authorized participants. In stress, the arbitrage between ETF shares and underlying metal can influence flows. If a discount opens, participants may redeem, pulling metal out. If a premium opens, they may create, pushing metal in. These mechanisms can either relieve or intensify tightness depending on where the metal is sourced and where it is needed. A market can have a giant stockpile and still have a delivery problem if the stockpile is not moving in the direction the contract system needs. And consider the psychological layer that sits on top of the mechanical layer. Certain levels become focal points because they were previous breakout zones, previous settlement clusters, or round numbers where risk managers set triggers. When price approaches them after a crash, orders cluster. But the reason orders cluster is not superstition. It's process, risk limits, rebalancing, hedging thresholds. All of it becomes synchronized around levels that are already in the system's memory. Now, the evidence. If you want to know whether a floor is real, you look for numbers that represent constraint, not stories. Numbers. First, the margin numbers. 5% on heightened risk is a large jump in required collateral. That means a trader who could control a contract with $11 of collateral for every $100 of exposure now needs 15. Multiply that across thousands of contracts, and you have a sudden demand for cash and liquid assets. If participants can't meet it, they sell. That selling can overshoot. Floors often form right after overshoots, when the forced component of selling has largely burned itself out. Second, the deliverable category. 0.7 million ounces tells you the pool the exchange recognizes as deliverable. If stress causes that pool to decline, even slightly, participants who are sensitive to delivery risk pay attention. It's not that 103 million is tiny. It's that the marginal movement can matter when open interest and delivery demand rise, because the market is a queue, and queues care about the last unit. Third, the ETF stockpile. 60 ounces in a major trust is massive. It can create comfort, but it can also create tension, because if the market begins to doubt accessibility, that stockpile becomes a question mark. Not because it isn't there, but because mobilizing it depends on authorized participants, redemption mechanics, and the willingness of holders to accept share conversions. The bigger the number, the bigger the potential impact if flows reverse, and the bigger the anxiety if flows don't reverse when the system expects them to. Fourth, positioning. 2000 suggests that some fast money is stepping back. In a market driven by narrative, that might be ignored. In a market driven by marginal liquidity, it matters. When speculative length reduces, who becomes the buyer? Often it's the entities with structural reasons, the ones who can hold through volatility. That's a recipe for a floor, because those holders are less likely to panic out on the next downtick. Now, put those together and the contradiction sharpens. How can silver crash so hard if inventories are huge? How can a market with over 500 million ounces in a major trust still behave as if it's constrained? Because the market is not a single pool. It's a set of pools connected by rules, frictions, and time. This is the part no one is discussing. The floor is often less about support and more about preventing a chain reaction in the collateral and delivery system. Think of the silver market as a 3-layer structure. Layer 1 is the headline price, the one you see on a screen. That price is heavily influenced by futures. It is the fastest moving layer. Layer 2 is the financing layer, margins, haircuts, repo terms, and the willingness of counterparties to extend credit against metal or positions. That layer moves slower than price, but when it moves with force. A small change in financing terms can cause a big change in position sizing because leverage is a multiplier. Layer 3 is the physical layer. Bars, vaults, refineries, shipping, and the ability to transform one form of metal into another. That layer moves slowest. It is governed by logistics, paperwork, and capacity. A true dislocation happens when Layer 1 moves violently, while Layers 2 and 3 cannot adjust in time. That's when you see paper price crash. While certain physical channels remain sticky, or you see premiums widen, or you see delivery anxieties flare. It's not that the market is lying. It's that the layers are updating at different speeds. So how is a floor executed in practice? It usually starts with stress that forces selling. Volatility spikes. Margin hikes hit. Weak hands liquidate. Price drops into an area where large players have predefined interest, either because it's an economic level for hedging, or because it's a risk level where their books behave better, or because below that level, the system starts to wobble. At that point, absorption begins. Absorption is not a dramatic moment. It's a steady process of bids showing up, often through algorithms that slice orders, through spreads that tighten, through the quiet disappearance of offers. On the tape, it looks like price tries to break lower and can't. It bounces, dips again, bounces again. That's not magic. That's a transfer of risk from forced sellers to stable holders. Simultaneously, risk managers adjust. Some desks reduce leverage, some roll positions, some shift from futures to options or vice versa. Some increase collateral buffers. Clearing members call clients not to tell them the market story, but to tell them the new collateral reality. The market's narrative may be loud, but the margin call is louder. And here's the key. When big money defends a level, it doesn't necessarily mean they're bullish. It means they're managing a system that becomes unstable if price breaks too far too fast. Defense is often about volatility control, not directional conviction. That's why the term floor fits. A floor is something you stand on so the building doesn't collapse into the basement. You don't have to love the floor. You just need it to hold. Now let's connect the dots between seemingly separate events. You have a violent spike and crash in late January 2026. You have an immediate margin hike from CME. You have deliverable category tracking that people watch like a heartbeat. You have a massive ETF stockpile that reassures some and worries others depending on their view of accessibility. You have positioning data suggesting fast money is already moderating exposure. When those appear together, historically, one thing tends to follow. A period where price becomes less about discovery and more about repair. The market repairs damage by rebalancing who holds risk and where the metal sits. After a shock like this, the market usually enters a repair phase. Sometimes volatility cools and price chops as the new margin regime rewires participation. Sometimes the dislocations linger, with spreads and premiums staying stubborn. And sometimes a fresh catalyst hits before the pipes relax, creating gaps and another round of collateral tightening. What decides the path is simple: whether volatility, financing terms, and deliverable flow keep improving or start deteriorating again. Notice what that implies. The story is whether the system can normalize after it has been forced to reveal its stress points. So what should be watched, not as advice, but as signals? Watch for changes in margin schedules and volatility regimes, because they dictate who can participate and at what size. Watch the behavior of deliverable categories and reported warehouse stocks, because they hint at whether the exchange system is being fed or drained. Watch ETF flows, not as a moral judgment, but as an indicator of whether large pools are being tapped or accumulating. And watch positioning data for whether speculative money is rebuilding exposure or staying sidelined, because floors tend to be strongest when weak hands are already gone and the marginal seller has been exhausted. Now we arrive at the divide. There are people who will always interpret silver through the loudest story of the week. They will call every drop manipulation and every rally destiny. They will treat price as an emotional referendum. Those people will always be late, because stories travel slower than collateral. Then there are people who watch the market the way a mechanic listens to an engine. They don't need to guess the driver's intent. They listen for misfires. They watch the gauges. They notice when the fuel line pinches. For them, a floor is not a line on a chart. It's a moment when the system stops getting worse, because the participants who couldn't afford the volatility have been removed, and the participants who can have taken over. That difference is not about intelligence. It's about attention. The information gap becomes a wealth gap because the system rewards those who understand the constraints. Institutions move first because they feel the constraints first. Retail moves last because it only sees the constraint after it becomes a headline. And that brings us back to the silver floor theory. Big money defends certain levels because those levels sit at the intersection of leverage, collateral, and deliverability. Break them too violently, and the system's cost of doing business rises. Hold them, and the system buys time to adjust. This is signal and noise, where we decode what matters before its headlines. If this connected dots you hadn't put together, you know what to do. Because the question isn't whether silver will move again. The question is whether the next move happens after the plumbing has been repaired or while the pipes are still under pressure.